Hey everyone, welcome back to the podcast on California politics and climate change. This is episode 7, and today we're diving into cap and trade. Yeah, I know, it sounds like something from Econ 101, but stick with me. It's actually a big deal. Okay, so here's the setup.
We know that since the Industrial Revolution, humans have been burning fossil fuels for energy, releasing carbon dioxide and other greenhouse gases into the atmosphere. As these gases trap heat, our planet has warmed, leading to extreme weather, rising sea levels, and threats to ecosystems and human health.
To slow down this warming, countries around the world have pledged to cut greenhouse gas emissions.
Enter California. In 2006, it passed landmark legislation known as AB 32, committing to reduce emissions to 1990 levels by 2020, but California didn't stop there. In 2008, it launched the first cap-and-trade program in North America, a unique market-based approach to drive down emissions.
By putting a price on pollution, it nudges companies to invest in cleaner practices and fuels, driving innovation and emission cuts.
All right, so let's get to the core of the matter. What exactly is cap and trade, and how does it fit into California's broader climate goals?
You got it. Cap and trade, simply put, puts a price on pollution. But before we dive into the mechanics, let's clear up some terminology. What's a cap and what's trade? Good question. Let's break it down.
The cap in cap and trade refers to the maximum amount of greenhouse gases, primarily carbon dioxide, that companies are allowed to emit. The trade part comes into play when a company reduces its emissions below its allocated limit. It can then sell its unused emissions allowances to another company that needs them, creating a market for pollution credits.
No. How does this work in practice? Well, it's ingenious, really. The state sets an overall limit on emissions, which decreases over time. Companies receive permits that grant them the right to emit a specific amount of greenhouse gases. This is the cap.
If a company finds ways to reduce its emissions, say by switching to cleaner production processes or renewable energy, it generates surplus permits. Now comes the trade. Companies can buy and sell these emission permits among themselves.
Those that cut emissions and have spare permits can earn revenue by selling to those who need additional permits to stay within the limits.
And guess what? California's cap-and-trade program is one of the largest and most ambitious in the world. It covers a wide range of industries, including electricity, transportation, manufacturing, and agriculture. The state began by setting emission limits for major polluters like power plants and oil refineries, and gradually expanded the program as reach.
But wait, how does cap and trade align with California's overarching goal of reaching zero net emissions by 2045?
It's all about setting the cap at the right level. When the cap is tight, companies must significantly reduce emissions to avoid buying expensive credits, fostering innovation and pushing them to adopt cleaner technologies and practices. On the flip side, if the cap is set too loosely, companies won't feel the pressure to cut emissions, and the program might not effectively drive down overall pollution levels.
Now let's talk about how cap and trade benefits both the environment and the economy. This is where things get really interesting.
Cap and trade offers a win-win scenario, theoretically, by encouraging businesses to find cost-effective ways to reduce their emissions. Companies that discover innovative methods can profit both from lower operational costs and the sale of excess emission credits. Over time, this competition drives down the cost of clean technologies, making them more accessible across various industries.
Now, how does cap and trade protect vulnerable communities disproportionately, people of color and low-income households who often bear the brunt of air pollution?
That's a fantastic question. California addresses this concern by investing a significant portion of auction revenue into programs that benefit disadvantaged communities. These funds support clean energy initiatives, public transportation, and healthcare projects, working to improve air quality and overall well-being in these areas.
Let's talk numbers. How much revenue has California generated through its cap-and-trade program? And how has that money been spent?
Since its inception, California's cap-and-trade program has raised billions of dollars by auctioning emissions permits. This revenue is allocated to a variety of environmental programs, including transportation, renewable energy, energy efficiency, and natural resource protection. For example, cap-and-trade funds have supported the installation of electric vehicle charging stations, funded solar and wind energy projects, and assisted with the electrification of public transportation.
Speaking of transportation, cap-and-trade has played a key role in California's low-carbon fuel standard, which aims to decarbonize the transportation sector by encouraging the use of cleaner fuels.
The LCFS requires fuel suppliers to reduce the carbon intensity of their transportation fuels, offering financial incentives for producing and using low-carbon alternatives. Cap-and-trade supports this effort by providing a market-based mechanism to further drive down emissions from the transportation sector. That's an excellent point.
California's cap-and-trade program isn't an isolated effort.
It participates in a larger network of carbon markets, including the Western Climate Initiative and the Regional Greenhouse Gas Initiative, which spans northeastern U.S. states. By collaborating and sharing best practices, these programs collectively increase their impact and create a more comprehensive approach to reducing regional emissions.
California also takes steps to ensure fairness in its cap-and-trade program.
Initially, many companies received free allowances to emit greenhouse gases, which raised concerns about privileged industries. However, the state has since reduced the number of free allowances and auctioned off a greater portion, generating revenue for environmental programs. Additionally, California offers compliance flexibility, allowing companies to bank emission credits for future use, promoting stability in the market and preventing sudden spikes in compliance costs.
So it's not all smooth sailing, right?
Despite its successes, California's cap-and-trade program faces ongoing challenges. One significant concern is the price of carbon. Critics argue that the current price doesn't provide sufficient incentive for companies to drastically reduce their emissions. Some advocate for a higher carbon price or more stringent caps to accelerate emission cuts.
Balancing environmental effectiveness with economic impacts remains a constant challenge. Finding the right balance between driving emission reductions and avoiding undue economic burdens on businesses and communities is a delicate task.
Another issue revolves around free allocation of emission allowances. While the program has reduced the number of free allowances over time, some industries continue to receive them, raising questions about fairness and potential market distortions. Striking a balance between incentivizing emission reductions and ensuring equitable outcomes remains an area of debate.
And finally, the scope of the program has raised questions. Although California's cap-and-trade program covers a broad range of industries, certain sectors such as agriculture and forestry are not fully included. Expanding the program's scope could further reduce emissions, but presents complexities in implementation and potential political challenges.
So let's wrap this up. What are the main takeaways from California's experience with cap-and-trade?
Over the past decade, California's cap-and-trade program has demonstrated that a market-based approach can effectively reduce greenhouse gas emissions. By putting a price on pollution, the program has incentivized businesses to seek out cleaner, more efficient methods of operation. Additionally, the revenue generated through the program has supported vital environmental initiatives and helped fund the transition to a greener economy.
Furthermore, California's experience highlights the importance of continuous improvement and adaptation. By regularly evaluating and adjusting the program's parameters, the state has been able to address emergent challenges and optimize the effectiveness of its emission reduction efforts.
Looking ahead, California's cap-and-trade program serves as a model for other states and countries looking to implement similar policies. The state's commitment to innovation, and its ability to adapt to changing circumstances offer valuable lessons for policymakers worldwide.
That's a great summary. But how does California's cap-and-trade program align with other climate initiatives like the state has groundbreaking climate legislation, Assembly Bill 32?
Well, cap and trade and AB 32 are complementary pieces of a larger puzzle. AB 32 established a comprehensive framework for reducing greenhouse gas emissions, setting targets, and requiring strategies to achieve them. Cap and trade, on the other hand, provides a market-based mechanism to incentivize emission reductions and drive innovation. Together, they form a powerful approach to tackling climate change.
You mentioned AB 32. Can you elaborate on other significant climate legislation in California and how they interact with the cap-and-trade program?
Certainly, California has been a leader in passing groundbreaking climate legislation. The state's groundbreaking climate law, Assembly Bill 32, requires California to reduce greenhouse gas emissions to 1990 levels by 2020. Another pivotal piece of legislation is the California Global Warming Solutions Act of 2006, also known as AB 32. This act established a comprehensive framework for reducing greenhouse gas emissions, setting targets, and requiring strategies to achieve them. Cap and trade, on the other hand, provides a market-based mechanism to incentivize emission reductions and drive innovation. Together, they form a powerful approach to tackling climate change.
And it doesn't stop there. California has adopted a number of other climate-related laws, including the Sustainable Groundwater Management Act of 2014, which aims to achieve sustainable groundwater management, and the California Renewable Portfolio Standard, which mandates a certain percentage of renewable energy in the state's energy mix. These legislative acts work in conjunction with the cap-and-trade program to create a robust and multifaceted approach to addressing climate change.
How does the cap and trade program support California's goal of achieving 100% clean electricity by 2045?
Clean electricity is a cornerstone of California's climate goals. The cap-and-trade program plays a crucial role by placing a price on the carbon intensity of electricity generation. This encourages power plants to shift away from fossil fuels and invest in renewable energy sources like solar and wind. Moreover, the program's revenue stream supports initiatives to modernize the electric grid, enhance energy storage, and promote the development of clean energy technologies. By driving down the cost of clean electricity and supporting related infrastructure, cap and trade accelerates the state's transition to a sustainable energy future.
We talked about the low carbon fuel standard. How does cap and trade work alongside LCFS to decarbonize transportation fuels? That's a great question.
The Low Carbon Fuel Standard, or LCFS, and cap and trade are complementary policies that work together to decarbonize transportation fuels. The LCFS sets a declining limit on the carbon intensity of transportation fuels, encouraging suppliers to invest in lower carbon alternatives like biodiesel or renewable diesel. Meanwhile, cap and trade provides a market-based mechanism that puts a price on carbon emissions from the burning of these fuels. Together, the LCFS and cap and trade create a powerful incentive for the production and use of clean transportation fuels.
That was a lot of information. Do you have any concluding thoughts on the importance of cap and trade in California's climate strategy and its broader implications?
In conclusion, California's cap and trade program has proven to be a pivotal tool in the state's fight against climate change. By putting a price on pollution and creating a market for carbon credits, the program has driven innovation, reduced emissions, and generated revenue for environmental initiatives. As California continues to strive towards its ambitious climate goals, the cap and trade program stands as a testament to the state's commitment to environmental stewardship and its ability to lead by example. Moreover, the program's success has broader implications for other states and countries seeking to implement similar policies. California's experience offers valuable insights into the design, implementation, and ongoing optimization of cap-and-trade programs, contributing to the global effort to mitigate climate change and transition to a more sustainable future.
Thanks for joining us for this deep dive into California's cap-and-trade program. We hope you found this episode insightful and informative. If you enjoyed this episode and want to stay in the loop on all things California politics and climate change, don't forget to subscribe. New episodes drop every week. And be sure to visit our website for more resources on cap and trade and other important topics. Until next time, keep questioning, keep learning, and stay curious.